The first 90 minutes versus the last 30 minutes.
Okay.
What do you think?
What do I think?
First
about
90 minutes. First 90 minutes versus
what
the last
context?
30 minutes.
What do you mean? Like what? Like
Zero DT options. Zeros.
the amount of the volatility of them is going to be much greater than. Okay, what?
Do you think because they obviously collapse at the end of the day?
Sure.
Do you think you'll do better selling something in the first on the opening and holding it for 90 minutes, or selling something in the last 30 minutes and letting it expire?
Wow. I think it's going to be pretty close to the same, but your swings are going to be much greater in the afternoon, like a multiple. If they even do that, I don't know if they do that. I think there'd be a slight edge to the morning, but it's going to be pretty close to each other. But I think the swings, the volatility swings, P&L swings in the afternoon are going to be a lot greater.
I think you're going to be really surprised by these results.
Okay, cool.
Now that
I don't know. We don't look at these.
If I say that to you, what does that make you think? Do you want to change your answer?
No.
We're going to take a look.
Just like I knew it was 54 and not 56, I'm not changing my answer.
On their day of expirations, in the right underlying, option markets are lively and liquid. Traders can experience much more rapid results when trading longer dated options. The speed accelerates near the end of a trading day. Trading zero DT options just before the close is the zero DT trade of the zero DT trades. How extreme is this acceleration? And how has selling premium performed early in the day or late in the day compared to each other? So we did a study, 52 weeks worth of data, and here were the choices. Opening, we considered zero DT short strangles sold at the market opening, $10, $20, and $30 out of the money, and then looked at their performance when they were closed after 90 minutes. We have had a lot of success doing the 10, 20, 30 out of the money strikes and closed after 90 minutes.
Right.
We contrasted this approach with selling straddles, $10 out of the money or $20 out of the money, strangles, between 35 and 30 minutes, just whichever one came up on our database, prior to the close, and letting them expire. Now, we know the first one's going to be pretty good, but we don't really know what the second one is actually going to look like. But let's go. So the 90 minutes prior to the opening, $10 out of the money strangles, win rate 64%, $20 out of the money, win rate 65%. Okay, these are all good. $30 out of the money, win rate 68%. Average P&L, you did better selling the $10 wide. We usually do the $20 wide. That's probably, these are just averages over a year.
Right.
And your CVAR, which is your worst loss, they're pretty much in line.
And these are strangles. I know they use strangles for the test here, but we would usually do something with defined risk, $20, $30 wide iron condor, something like that.
Yeah.
Just because of the buying power use.
Yeah. So this is kind of classic. Okay, this would be exactly in line with what I thought. Now, here's the surprise. 30 minutes prior to the close, straddles, win rate 40%. $10 out of the money, 57%. $20 out of the money, 82%. So the win rate went way up. But here's the problem. Everything lost money. CVAR was way higher. Because some of the outlier moves just killed you. CVAR was like double, and every single approach here lost money. That's bad.
That's bad.
So you know what this tells you? There's a very important red flag here. And the very important red flag is don't sell zero DT premium with a half hour to go. The opposite is if you have zero DT premium with a half hour to go, get out.
Right.
As crazy as this sounds, there's nothing good about this page. I was surprised by that.
Me too.
While the zero DT trades are generally fast-paced, near market open is relatively calmer, and the short premium trades managed quickly have been generally profitable over the past year. Selling short premium near the close, however, was not a successful strategy. Large risk for small credits saw more big losers than they could handle. It's a two-sided market for retail traders, and long zero DTs do not have the same buying power issues as short options. We can consider the other side, right? Because you could theoretically take the other side if you wanted to. During the last minute of their lifespan, all the features of zero DT options become exaggerated. If you choose to trade during this period, extreme attention is advised. Be vigilant.
You're advising now?
Our writers are.
Good.